Excellent. All right. So John Templeton said the four most dangerous words in investing are "this time it's different." And so I'll just explain what we mean by that. So America right now is dealing with three crises simultaneously. It's unprecedented, really. You know, the first one is the coming election. This is shaping up to be one of the most important elections in American history. And really at this point, it's a couple weeks away. So, you know, the traditional way of life, American way of life is being challenged. Battle lines are being drawn. The right's yelling law and order, and the left is yelling poor leadership. You see a Democratic Party that's split. There's a part of the party that's demanding radical change, and it's pulling the party to the left. The feeling is that law and order is code speak for African American suppression. There's a factor that's thinking maybe we can't win from the left or the right. We got to be more moderate, and they're trying to pull the party back from the middle. You know, the election coming is a crisis, a major crisis. The second crisis is civil unrest and rebellion. As we speak, 110 cities in the states are experiencing civil unrest. Washington, D.C., Chicago, New York, Philadelphia, Baltimore, Cincinnati, Pittsburgh, Wyoming, Delaware. Among other things, we're witnessing fires, protests, looting, cars overturned, stores being demolished, and the spark was the murder of an African-American man. And the third crisis is the pandemic, which is creating chaos beyond border on panic, right? Is it going away? Is it coming back? What's happening? A virus from China killed more than 1 million people worldwide and more than 100,000 in the US. It's unprecedented. What I just described there was actually the summer of 1968. The presidential race that was tearing the country apart wasn't Biden-Trump, it was Nixon and Hubert Humphreys. The murder of the African American wasn't George Floyd, it was actually Martin Luther King. And the virus wasn't COVID-19, it was the H3N2, the Hong Kong flu. The Dow closed that year at 945. Last night it closed at 28,512. Everything is different, nothing has changed. So, and when I hear unprecedented, I think maybe, but 1968 looks a lot like this year. Philip, I'll throw it over to you. Thanks so much.
Thank you. I think that was a fantastic introduction and a reminder in terms of what we've seen in the past, how the markets have gone through it, and what we might be headed towards in the near future. I mean, you mentioned the election. I have spent so much time over the last month talking about the election, and some people are surprised and maybe a little disappointed at my comments around it. But ultimately, I'll jump to the conclusion, which is it really doesn't matter. Now, policies that might come following the election do matter, but the election itself, you can't really gain an edge on investing trying to guess on who might win, what party will control Congress, what party will control the Senate, and what policies they may implement over the course of the next 2 years before things shake up and we head into the midterm elections. All the while, what I do and what my team does is try to identify the opportunities in front of us where we believe that we can make money, we can preserve our wealth, or we can protect our capital against an eroding purchasing power. And so we do that through a number of different ways, and I'm going to really address those today. And I think some of the ways that we shouldn't be considering investing our capital. So the first thing I want to talk about is where are we in terms of the economic cycle? We've seen the global pandemic. We've seen what it did to the global economy with the COVID lockdowns over the course of February in Asia and March and April in Canada and the United States and Europe. Where are we today, and where do we think we're headed through the remainder of this year and into 2021? And then some of the longer term thoughts in terms of what we think some of the potential outcomes of all the monetary and fiscal stimulus, that's the support by the central banks around the world and the deficit spending by governments around the world to fill that economic gap that occurred earlier in the year. There will be consequences to it. We should consider what those consequences are and position accordingly, because there will be some opportunities that come about as a result of that. And then lastly, we do have to contend with some short-term volatility as the markets do kind of digest or weave their way through the uncertainty that is the U.S. election. But even with everything that I said earlier, that we really don't think that the election matters much at all, the markets nonetheless will respond to it, as we're seeing today. And the markets are responding to the fact that a stimulus deal in the United States, we believe is forthcoming, but it might be a little bit further away from us today than where we were, say, last Tuesday in the market. So first, if we look at the economic environment, there's been a lot of talk about it on the news. A lot of has been written about it in the paper, that perhaps you've seen what I've seen, which is some economists are calling this a K-shaped recovery. And in a way, I almost take exception to that, because the reason they argue for a K-shaped recovery, and let me just explain what that means. They mean, if you look at the letter K, out to the right, you have part of that letter K that is upward sloping, and they're saying that's part of the economy. Part of the economy is recovering quite strongly. But then you have this downward sloping shape as well, and that's part of the economy that is stalling out or isn't growing quite as strongly. The truth of the matter is, every economic recovery is a K-shaped recovery. Every economic recovery goes at a different speed with all of the sectors that are concerned. In this case, the economic recovery is very strong in the manufacturing sector, in the retail sales sector, in the housing sector, and quite weak on the services side, where restaurants are being shut down and bars are being shut down and gyms are being shut down. The truth of the matter is, the areas of the economy that matter to me as an investment strategist and should matter to investors broadly are actually doing quite well. These are retail sales, again, as I mentioned, retail sales, manufacturing, and housing. These are just three examples of the economy in the United States and Canada and around the world that is actually doing quite well. And in some areas is even growing at a stronger pace than what we saw at the beginning of the year. Now, why is this the case? Well, it is the case because this is a bifurcated, this was a bifurcated recession, and it's a bifurcated recovery. Bifurcated in the sense that, yes, the services side of the economy is struggling. But that's not what makes up the stock market. That's not what the market really is concerned with. If we look at the percentage of the stock market that is tied to restaurants, restaurant services, things like that, it's really, really small. If we look at the makeup of the equity markets that are tied to manufacturing, it's quite large. And let me just give you a quick example of it. People often think of Amazon as a services company. Amazon, they ship packages all around the world. You can go online and you're just a couple clicks away from having whatever you want delivered to your door, potentially in the same day. So some might think that Amazon as a shipping company is a services company. We actually don't think that. In fact, if you want to see the health of Amazon, don't think of it in terms of shipments, rather. Think of it in terms of manufacturing, because what Amazon ships are manufactured goods. And so really, if manufacturing is expanding, Amazon does well because there's a demand for goods and Amazon is facilitating that demand. And so this is how we think of the market. And this is why the stock market has recovered to the levels that we've seen over the last almost 8 months now. This is the good in the market. And when we look forward through 2020 into 2021, we see this as quite sustainable. Housing market is another good example of what we're seeing. Now, the housing market, we're looking at in the States in terms of new housing starts, existing home sales, new home sales, and demand is quite strong. And in fact, housing starts have rebounded to their pre-COVID levels. Now, this benefits not only just the home builders themselves, which are a good part of the market, but everything associated with that, all the consumption that goes along with that, furnishing the homes, putting appliances in the homes, trips to Home Depot and Lowe's. And in fact, Lowe's, off of the low of the market, March 23rd, has been one of the top performing stocks in the S&P 500. This is a positive. Now, people are not going to enter into the purchase of a new home if they're concerned about their job, if they're concerned about their financial position. And so this tells us that the U.S. economy, where we're concerned about, it continues to do quite well. This does not address the fact that what if we were to see or as we're seeing now, a second wave of the coronavirus. Potentially, we can see a third wave in the wintertime. Could we see a return to recessionary conditions of March and April? Perhaps, but we think there's a great reluctance to go that route. We think governments are very reluctant in this country, in the United States and around the world, to completely shut down economies again, to issue stay-at-home orders again, because we've learned a lot in the last 6 months. We've learned how to treat this disease. We've learned how to manage the economy in such a way that you don't need a complete shutdown. You can focus on where you could see the potential breakouts of infection and just shutter those businesses, which tend to be a little bit more on the restaurant side and the bar side and so on. Again, less focused on areas that would impact the broad market. And so we're assuming that we don't see a complete shutdown. And we're also assuming that we will continue to see fiscal stimulus out of the government of Canada, government in the United States, and across Europe. And so there are some positives that we think there, but we've learned a lot in the last 8 to 9 months, and that knowledge helps us advance forward. Now, let's look at some of the longer term consequences of this, though, because there are some things that we need to consider with respect to the fiscal stimulus and the monetary stimulus. Here, we think what we are likely to see, our models would suggest that we could start to see some higher inflation over the course of the next year. Now, when we say higher inflation, we don't think back to the 80s. We think it's highly unlikely. But inflation in the 2 to 3% range, we think is realistic. And that is likely to push longer term interest rates higher. We have a pretty much a firm commitment from the Bank of Canada, from the Federal Reserve in the United States, to keep short-term interest rates at their lower bound. That's 0.25% in Canada. It's effectively zero in the United States. We don't think we're going to see negative interest rates in North America. They tend to be counterproductive to economic growth and to what the Fed and the Bank of Canada really want, which is higher inflation. But the longer end of the curve, as we do see inflation expanding beyond 2% into 2021, which is what the Bank of Canada wants, what the Federal Reserve wants, we think that's going to result in higher interest rates, longer term interest rates, which means Government of Canada bonds, like the 10-year, for example, Government of Canada bond, we think could yield over 1% by the middle of next year. The 10-year US Treasury, 1.5% by the middle of next year. That doesn't sound like a lot, but what it means is it puts long duration bonds at risk of being in a loss position. Now, to counteract that, knowing that and being aware of that, we think that we call it credit or corporate debt is actually favored over government debt over the course of the next couple of years, where you're being paid a proper interest rate relative to inflation that we see coming over the course of the next year. The other consequence to all this fiscal and monetary stimulus, in particular that we see out of the United States, is a weaker US dollar. We've seen the US dollar weaken over the course of the last couple of months, and we think it's going to continue. Now, part of that weakness of the US dollar has driven gold prices higher, and we think that's going to continue as well. But in a weaker currency position, what you want to own to hold on to purchasing power is real assets. Now, real assets would include gold, but it would also include stocks, companies that have pricing power, companies that can grow their earnings by increasing their prices in an inflationary environment or in an environment where the US dollar is weakening in terms of purchasing power. And historically, we've seen stocks keep up with inflation in this regard. And so we think that's a positive. And with everything that we see coming down the road, it reinforces our view that companies that pay a dividend, that can grow that dividend organically, and that have pricing power are in a position to benefit. And these companies right now do tend to be in the more cyclical areas of the market, materials, industrials, consumer discretionary, even technology, although you do have to pick and choose your spots there, as some tech companies are reflecting overvalued prices. And then lastly, let's come back to the election again for a second and come back to short-term volatility. We're seeing the markets down today. It's in reaction to the fact that we might not see a stimulus deal in the United States as quick as we want. I believe one is forthcoming. It's just what number are we going to end up with? And are we going to be closer to the Republican number or closer to the Democrat number? I don't know. But we do have confidence that both parties want to see a deal done, and it will get done at some point in time, if not before the election, then after the election. Regardless, October tends to be a volatile month. October is in advance of an election. In fact, going back to 1952, are the worst month of the year. And so do I think that we can continue to see some volatility this October? Yes, I do. We saw in September, and I think given the uncertainty around this election, given the uncertainty that we see in terms of the results of the election, meaning, is it going to be the morning of the 4th of November, or is it going to be a couple weeks thereafter that we get the final results of the election? That all creates uncertainty, and the markets respond to that. Typically, they respond in a negative way. What we and our portfolio managers have been doing, however, is taking advantage of that, knowing that this could be a more volatile month, and also knowing that the areas of the economy that we're focused on continue to do well, continue to recover, in fact, and enter into a new growth regime. That gives us confidence that we're less likely to re-enter a recession over the course of the next 12 months. Therefore, we have a higher probability of a positive return over the next 12 months. And we want to pick up those assets when they're cheap. And so I would say, don't be surprised if we continue to see some volatility in October. Don't be surprised if we see the markets down 10%. Our view is that we want to take advantage of that. Our portfolio managers will take advantage of it because we think that's an opportunity and not a concern that something more ominous is occurring. With the election itself, because I do want to address this, because there are some beliefs out there that one party might be better for the market than the other. We've looked at this going back to World War II. So 1945 is when we started. And what we've seen is that it doesn't matter which party is in. We can speculate as to whether one party might be more left-leaning than the other, but until we actually see policy, it's a pointless discussion. And policy, remember, isn't driven by just one individual. You have the House of Representatives and you have the Senate. And even though we have had in the past one party sweep all three houses or branches of government, that doesn't necessarily mean that it's a foregone conclusion that policy is going to be rammed through. Historically, however, what we've seen between Democrats and Republicans is that when we have a Democratic president, you do tend to see a slightly better return. The average annualized or the average return, calendar year return when a Democratic president is sitting is 14.9%. When it's a Republican, it's 10.6%. There is a difference there, but we would caution anyone to just immediately assume that Democrats are better. The Republican number is skewed lower by George W. Bush, who suffered 2 bear markets and 2 recessions during his 8 years in office, while the Democratic numbers are being skewed upwards by Bill Clinton, that enjoyed 4 years of 20% plus returns on the S&P 500. You pull those out and the numbers start to look a lot closer. But then we also looked at the makeup of government, who controls or which party controls the White House, the Senate, and Congress. Here too, actually, the numbers would suggest that Democrats are favored more so than Republicans, but we wouldn't say that it's necessarily policy driven. We think it's more of a random walk and just where Democrats or the voting ends up and coincides with the economic and business cycles. Republicans do tend to suffer recessions more so than Democrats, and therefore they suffer more bear markets than Democrats. Is that because of Republican policies? We're not so sure. And so we would say that regardless of who wins, really, we're going to continue to focus on the areas of opportunity, the areas that we can make money, and we're not going to guess on what it might mean.
Trump, we kind of view Trump as, if Trump gets in, like I'm hearing all kinds of calls, if Trump gets in, things are going to go south. And I say, well, he's in right now. So we kind of know what it is there. But no matter where you are in the world, I think there's probably somebody who's worried about the exact opposite thing of you happening. And that's why we kind of have a balanced market. What if we see, and I guess, Philip, one of the questions I get is well, why don't we just all go to cash and just wait in cash, and then when things drop, we'll buy back in again. And so, what is the probability of something like that working? What would you say the probability of just going to cash and then waiting and then just investing when the quote unquote right time is?
Well, first, it's extremely difficult to try and time that. It's unbelievably difficult, I would say, because what's the signal? Right? Even professionals really, there are numerous, for everyone that says the market's going up 10%, I can point to someone that says the market's going down 10%. What do you do during that time period? You mentioned Sir John Templeton at the beginning of the call. One of the other things that I remember him saying, or he's famous for, is the best time to invest is when you have the money. Trying to time the market at when is good or when is bad is going to make a fool out of you. For example, no one believed, or very few, I would say, believed that the market was going to recover as quickly as it did. Yet here we are. So for the $350 billion that was redeemed in the United States in March of this year, those investors locked in their losses. I mean, what a tragic mistake that was. Well, let me just give you some numbers. Going back to 1929, the probability of a positive return for the S&P 500 over any 12-month period is 68%. So that does mean that, yes, you could lose money over a 12-month period. But if we have confidence that we're not headed into a recession, the probability of a positive return over the next 12 months goes up to 78%. Now, what we're really concerned about is a steep drop in the market. So let's say something, I don't want to be down more than 20% in 12 months' time. Well, that has only happened 1.8% of the time outside of recessions. So the probabilities are with me that we're probably going to see my dollar invested today higher in 12 months' time. And if it's lower, it's not going to be lower by much. So, what we say what we should do is every client has somewhat of an optimal asset allocation based on their goals and needs and so on. As you go through your reviews with your clients, their asset allocation is unique to their goals. Market gains and drops can skew that asset allocation. So what we suggest is, rather than trying to time the market, stay invested. Bonds, certain areas of bonds will make you money. Equities can make you money. And when things get knocked out of whack, rebalance. So rather than saying, I'll just wait until the market is down, well, no. When the market, if we do see a correction of 10%, then what you do is you shift some from fixed income into equities, take advantage of it. When equities run much stronger than fixed income, trim some profits, put it back to fixed income, keep your portfolio rebalanced. Our work would show that will deliver a 60-40 portfolio managed that way, delivers over the long term almost exactly the same return as a 100% equity portfolio, but much less volatility.
Yeah, I'm not sure if you remember, Philip. I remember where I was the night, and I was at a client's art show. Like the client's, well, she's an artist, and I was at the art show. And just before, they were kind of having the election results, and it was kind of undecided. And then when the show was over, it was like Trump had won. I was like, oh wow, I'm really surprised. And then I got home and I looked at the futures market. And the futures market, for everyone listening, is the market when the market closes, you can kind of trade after hours, and it can really skew things. But the futures market was down dramatically, like very dramatically. And the next day, I was like, oh boy, I'm going to go into work, and this is going to be an ugly day in the market. The market was up tremendously, and so I really caution folks to say, like, you're trying to outthink everyone else. You're going to predict what the market's going to do. Hey, even professionals got it wrong with Trump. They were thinking the market was going to be down, and the next day it was up significantly. And so trying to make these big wholesale changes, going to cash, getting out, I found that over time that you are going to have a significantly lower rate of return. You're going to add more stress to your life than holding a portfolio that meets your goals and needs. So I'm just going to check one more time to see if I have any questions. Oh, I do have a question here. Do you have any concerns with the current price to earnings ratio at all-time highs? Is this measure no longer a good proxy to evaluate future prospects?
It's a great question, and one that we do pay a lot of attention to. But the way that we look at it, you can't just look at the price to earnings multiple in a vacuum or just on its own. You have to look at it relative to inflation and relative to interest rates. And so what we've seen historically is as inflation goes higher, your forward returns in a way are worth less. So your PE multiple comes down. As inflation moves lower, your PE multiple can go up. Now, there is an optimal range for your PE multiple relative to inflation. Yes, we would say the markets are trading full to, in some cases, modestly overvalued. But that's also normal coming out of an earnings recession like we've seen, or like where earnings have collapsed like they did in the first and second quarter. And so we do expect PE multiples to come down as earnings growth resumes. Now, we're going to see that likely in the fourth quarter and then through 2021. I guess my point is we recognize that valuation is high. That rolls into our forward return expectations, where we believe that market returns over the course of the next 12 months aren't going to be 60% like we saw from March 23rd to September 2nd. They're more likely to be 6 to 10%, much more an average to slightly below average return, but we have a relatively high conviction in that. Now, that is going to result in your PE multiple coming down to a more reasonable level. And what would that be given inflation where we see it between 2 and 3%? Probably somewhere between, say, 21 and 23 times trailing earnings. That is above the historical norm, but inflation is going to stay below historical levels. And therefore, we can support higher PE multiples. Technology, maybe this question is a little bit more technology leading. There are a number of companies in the technology space where you sit there and you go, this doesn't make a heck of a lot of sense. This reminds me a lot of 1999. And I think that we could see tech companies, the really overpriced tech companies, take a good, healthy fall.
I know you have a few more minutes. I've got a couple more questions in here. One was about transportation of goods. So how the railways do. So like Canadian National, Canadian Pacific, how are they going to do, say, what is their prognosis looking like with what we're seeing there? Is there going to be much of an effect on them?
Well, I mean, it was a very short-term effect. What we've seen out of the railroads is a fantastic rebound, both in terms of just the overall business, and in freight loads, if you look at it that way, and in terms of the stocks. So we've had really, really strong results out of the rails. Not only have they recovered to prior or pre-COVID levels, but they're above that. Unfortunately, we would say the easy money's been made on the rails. Their businesses are quite solid, but a lot of those gains have already been realized.
And a lot of that has to do with oil, I think, too. Like they're shipping a lot of oil, so if you get a pipeline approved, they might suffer, that type of thing. So I would think
potentially, but yeah. They actually, what they do is they actually limit their the amount of oil that they'll take, because it is so volatile, and they don't want they prefer repeat customers, and so they recognize that oil is at the whims of global demand, and so they would actually prefer if they had less oil business over the long term than more.
No, that's a good point. Question about a vaccine. Had people wanting to know, if a vaccine can't be developed, what does that look like for the market?
Well, it's interesting. Well, again, I think look at the areas of the economy that are important to the market, and they're functioning well. There's an epidemiologist at the University of Toronto that's talking about this, saying that we might have to just learn how to live with this virus, because the vaccine, if the virus mutates, the vaccine that we've developed for the one today is useless. So, it's a good question. I would say I don't expect the markets to be in big shock. I think if it was the case that vaccine couldn't be developed, we would be forced to learn to live with it, and we would go about our daily lives.
The H3N2 is still around today, right? So from my earlier story at the beginning of the call. So it
exactly.
Still around. question: How do you evaluate whether a stock is overweight, overvalued? I guess. How do you evaluate if stocks are overvalued? Like what is that? Like some experts are saying a lot of stocks are currently overvalued.
Yeah, we don't rely on any one measure. I did mention PE multiples to inflation. Yeah. That's one that we look at. We look at market cap to GDP, so the value of all the companies relative to the U.S. economy. We look at the value of all the companies relative to the money supply. And so we're getting some mixed signals. Now, there isn't any signal that says the markets are cheap. But if you look at valuation, based on some of the things that we look at, it would say that markets are fully valued to slightly overvalued, but in the context of a rising earnings environment. So when we think forward over the next 12 months and saying, okay, based on all the other economic indicators that we have, it's telling us that earnings are likely to be back to 2019 levels by the end of 2021. You attach a reasonable valuation to there and you go, markets are fair.
Utilities have often been a safe haven, or not safe haven, but the defensive stock. Like, do we see that going forward, that utilities would still be a defensive type of position for stocks?
Well, yeah, certainly a defensive stock. Yes, if we felt that we were heading into an environment of risk over the course of the next, say, 12 to 24 months, then yes, we think that utilities would be a decent place to be. However, that's not the case today. I think when I look at utilities, yes, you do have a decent dividend there, but you're not going to see a lot of growth out of them. And in fact, they tend to be interest sensitive because many utilities are very long duration assets, like pipelines, power structures, and so on. And so in the environment where we can see a rising interest rates over the course of the next year, I think utilities are largely going to underperform. One area that we didn't talk about that I think is very attractive, though, where you can still get a very, very attractive dividend, is with the banks. So here too, if we think that the yield curve is going to steepen out, if we think longer term interest rates are going to move higher, that's good for the banks. And we think that the Federal Reserve, Bank of Canada, want strong banks to support their inflation efforts. And the banks are very attractively valued today. I would argue, going back to markets, if we look at the banks, I would say they're cheap. And they're paying dividends between 5 and 6%. So less utilities, more banks. That's how we would lean over the course of the next 12, 24 months.
There are some more stocks coming in. I can answer those. I know you have to go, Philip. I really appreciate your time. Thank you so much. Thank you, everyone, for joining. If you do have more questions, send them in to me, and I can get some answers for you. And would love to connect with everyone, just about the call or any questions you had, later today or this week. So, Philip, thank you so much. Brent, thank you so much. Thanks for everyone being on the call. And